A lot of people have a really hard time reading the market, aka knowing exactly what to look for when talking about market structure. So in this video, I'm going to give you my tips and tricks when it comes to looking at the market and understanding exactly what direction is favored. Having a bias or understanding where the market is most likely going to go is essential for your success in trading, especially if you're an ICT trader, which I imagine the majority of my following is. Well, then the daily bias or having a general idea of where the next move is going to go is simply one of the most essential parts of trading, or at least it should be. If we take a look at my screen, the first thing that we're going to be talking about is something I like to call structural displacement. The first thing I want you to understand is how we identify highs and lows. Now, obviously, I don't just mean any high and low. I mean having a look at buyers and sellers when it comes to price hitting either a high or a low. Let's take a look at the picture that I have right here. So as you can see, we have established some highs right here, and the market came up and swept those highs. Now, what I want to pay attention to understand the order flow of the market is how the buyers and sellers reacted to hitting that high. And as you can see, we got close to zero follow through after hitting the high, and price sort of just consolidated right here. Now, had this been a very bullish market, I would have anticipated price to simply keep moving above the high with displacement. So the first thing that we look for is, do we see displacement after hitting a high? Or in other words, do we get follow through after hitting a high? In this example, we obviously didn't. Price consolidated for a bit, and now we are sort of seeing the market going lower. Now, once the market goes lower, we want to pay attention to the same thing with the highs, but with the lows. Do we see any sort of follow through after hitting the lows? And as you can see, this is the first swing low that price really hit, and we got a lot more follow through on that low than we did at the high. As you guys can see, price moved significantly lower after hitting the low than price did up here after hitting the high. So at this moment in time, we are not getting any follow through whatsoever to the upside after hitting highs, but we are seeing some sort of follow through to the downside after hitting lows. And that's exactly what I mean by structural displacement. It's simply looking at the market and how do we react to hitting the last swing high that we hit versus how did we react to hitting the last swing low that we hit. Taking a look at this, you can see what side the market favors. And in this example, it is obviously the short side of the market. Again, because we are getting no follow through to the upside after hitting highs, but we are seeing some follow through after hitting the lows, which again indicates that the order flow or the sentiment of the market is bearish. Now, the next thing that we want to be looking for is PD array violations. Okay, so identify bearish and bullish PD arrays, and then you identify who's in control based off of how price react to bearish and bullish imbalances. So when I say PD arrays, I mainly refer to fair value gaps. And as you can see right here, we have a bullish fair value gap here, and we have a bearish fair value gap right here. So taking a look at it, we can obviously see that the bullish imbalance that we had in this leg got violated pretty fast. And right after we violated the bullish imbalance right here with this candle closure, we immediately went to retest the bearish imbalance. And as you can see, price actually held this bearish imbalance quite nicely. And that again adds on to the confluence. So currently we are not holding the bullish imbalances. We are holding the bearish imbalances. We are also seeing some follow through after hitting the lows. We are seeing no follow through after hitting the highs. And so this brings me on to my next and final point, and that is pullbacks and retracement. So identify equilibrium or 50% of the range, and also identify the optimal trade entry. Because again, based off of what we analyzed right before, we have established that, okay, the market sentiment is probably bearish. There's a high chance that the market is favoring the short side of the market. And if that is the case, and we actually got the direction right, the highest point I want the market to go is going to be 50% of the range. Okay, that is the easiest way to anticipate a top of a pullback or a bottom of a pullback in a bullish market. And so what I want to do is take my entry at around equilibrium of the range, because again, if we got the order flow right, that is 9 times out of 10 the highest point a pullback should go. Now, sometimes you will see the market go all the way up to optimal trade entry at around 0.618 and all the way up to 0.79. But the majority of the time, the pullback is going to end at around equilibrium of the trading range. So what you can do is look for your entry at about equilibrium of the trading range, and then include some of these zones in your stop loss just in case the market wants to come up here. So again, let's run over it one more time. Firstly, we established highs and we established lows. How did the market react to hitting the highs? Did we get any follow through? No, we didn't, right? No follow through right here. Now, we sold off after hitting the highs, and now we want to pay attention to how we treat the low. Did we get any follow through? Yes, we did see a bit of follow through, at least compared to the high, right? Now, after that, we have established that we believe there's a higher probability that the market sentiment is bearish, and therefore we are going to look for an entry on the next pullback, which again should end at around equilibrium of the range. So if that overlaps with some sort of PD array, that could be an order block, a fair value gap, a breaker block, whatever it might be. If it overlaps with 50% of the range, well, then that is a great entry if you got the market order flow right. And by the looks of our analysis, we should have gotten the analysis right. Now let's take a look at some examples on TradingView. I'm going to show you 3 examples. One is going to be a gold chart, another one is a Euro USD chart, and the last one is going to be a NASDAQ chart. So right here, we are looking at gold, and something I want to tell you guys is it does not necessarily have to be lows and highs. It could also be higher time frame key levels. So if I jump to a daily chart here on gold, you'll be able to see that we have a swing low made inside of a larger daily imbalance right here. The market then came down, swept the liquidity under the low. We didn't see a lot of follow through, at least not on a daily chart, and we hit the daily imbalance. That is obviously a significant key level on a higher time frame. And so if we zoom in here to a 15-minute time frame, you'll be able to see that after hitting the higher time frame key level, we got a lot of follow through when we hit the highs. So just like in the last example, identify the high. In this case, there's no low to identify, but we have a higher time frame PD array, which is this daily imbalance. Now, obviously, we did not see a lot of follow through after hitting that daily key level, but we did in fact see a lot of follow through to the upside after hitting this high right here. So again, I'm going to anticipate that the market sentiment has now switched from being bearish to now being bullish after hitting that daily key level because of how we treated this high right here. So based off of our analysis, the market order flow should be bullish, or the trend of the market is bullish, or the market sentiment is bullish. There's a lot of different words we can use this for. But again, if our analysis is right, the lowest it should go is equilibrium of the trading range, which is right here. Now notice how this actually overlaps with this 15-minute order block right here. So what I'm going to do is place my entry at equilibrium of the trading range, which is going to be right there. My stop loss is going to be a tiny bit below this swing low here, and my take profit can go to the equal highs that we have now created up here. So let's actually play this out and see if our analysis was indeed correct. And as you guys can see, our analysis was pretty spot on right here. So again, we identified a higher time frame key level, which normally we would have had to identify a low over here, but instead we used a daily key level, which we also can do. So daily key level, or just a higher time frame key level, was identified. We saw that we got 0 follow through after hitting that to the downside. Now we want to pay attention to the highs, and we did in fact see a lot of follow through there. So based off of our current analysis, the market order flow should be bullish. If the market order flow is bullish, well, the pullback of that bullish order flow should end at around equilibrium of the range. Now that happened to overlap with this order block right here. Again, it doesn't have to be an order block, just any PD array, whichever you prefer. I took my entry from equilibrium and I took my profits at the equal highs, and it ended up working out perfectly. So now here we have an example on the Euro USD where we have an external range high getting swept here. And obviously you guys can see that we are seeing 0 follow through to the upside after hitting the high. Now, after we've identified that we got no follow through to the upside after hitting the high, we want to pay attention to how the market reacts to hitting the next swing lows, which are these right here. So obviously we're seeing a bunch of displacement below all the lows that we are hitting. So what we can anticipate is that the pullback is again going to end at around equilibrium of the trading range. So what we would do is pull out our premium and discount tool, and then we would look to take a short position from equilibrium of the trading range. So that is exactly what I'm going to do. My short is going to be right at equilibrium. My stop loss is going right at the swing high there. And then I can sort of dabble around with my take profit. I can go for external range liquidity, which is down here, or I can take it off at internal range liquidity like the low right here, or even the equal lows that we have just created. Now for this example, I'm simply just going to go for the equal lows right here, which is going to be a 1.83 RR position. Again, to give you guys a more realistic example of what your trades could look like. So without further ado, let's play it out and see if our analysis was right. And it was indeed a perfect analysis using the exact same analogy as I just told you before. Identify the high, right? Market runs up, sweeps the high. Do we see any follow through? No, we don't. We then get a lot of follow through to the downside. Now, does that follow through also happen when we hit the swing lows like we do right here? And yes, it keeps on dumping through the lows. We see a lot of follow through even after hitting swing lows. So we are going to anticipate that the market order flow is bearish and we want to capitalize on the pullback, which again should end at about equilibrium of the trading range. So that's where we are going to take our trade. Now let's take a look at the final example here, which was the NASDAQ example that I showed you right here. Again, what we want to pay attention to is the high and the low. So we have identified a high, which is this one right here. The market runs up and then sweeps that high. Now, do we see any follow through to the upside? No, we don't. Then we start to see follow through to the downside. Now, does this also happen when we hit the swing lows? Yes, we certainly see more follow through to the downside than we did to the upside. And so based off of just looking at highs and lows and how the market responds to hitting either one, we are going to anticipate that the market order flow is bearish. And again, we want to capitalize on the pullback. And where does the pullback typically end? Well, it typically ends at about equilibrium of the trading range. So that is exactly where we are going to place our entry. I'm going to place my stop loss near the high, but I don't really want it all the way up there. And then I'm going to go for the other external range liquidity low that we have in this market, which is going to be this low down here for about a 3.95 RR. So let's see exactly what happens. So quite a longer one where we got teased for a little bit here, but you can see the analogy playing out perfectly, right? Now, right here is a perfect example of the market sometimes going to optimal trade entry, even though you get the bias right or the direction of the market right, kind of like I mentioned earlier in this video. So right here, we come down, we get very close to sweeping the low, but we actually just leave equal lows instead. We therefore have the same intentions or the same idea about the market, and that is obviously that the order flow is bearish. So in the previous examples, the market reversed at equilibrium, which you can see this one actually didn't. But if we take a look at the optimal trade entry, you can see exactly where the pullback ended. So every now and then the pullback will end in the optimal trade entry and not equilibrium, which is why I generally recommend that if you enter off the equilibrium, you include all three zones of the optimal trade entry in your stop loss to make sure that if the market wants to go to optimal trade entry, you also have that included in your trade. So that was my guide on ICT market structure, or just market structure in general. This is how I analyze the market order flow on a daily basis and actually use it to my advantage. Because again, we want to be trading with the order flow of the market. It simply makes it way easier to profit. So understanding market structure is essential, and I really hope you learned a thing or two by watching this video. So without further ado, thank you a lot for watching, and I'll see you in my next video.